back to today's Global Macro Explainer. We've got a ton of ground to cover from overnight, so we're setting a brisk trading floor pace right out of the gate. We're going to break down the global macro weather report and then zoom straight into the tactical levels you need for major currencies and Indian equities. Let's get into it. Okay, let's dive into this staggering number. $40 trillion. That's the current U.S. national debt, and it is literally doubled in just a decade. But here's what's even more critical for markets right now. Debt servicing has jumped 15% this year alone. It now eats up roughly 20% of all tax revenue. The Treasury is trying these band-aid solutions like doubling longer-dated bond buybacks, but honestly, it's creating massive, unprecedented pressure for the Fed as we head into Jackson Hole. And against that heavy debt backdrop, the global economy is flashing some seriously mixed signals. U.S. weekly jobless claims just fell to 208,000, so services are staying strong even as manufacturing kind of softens up. But jump across the Atlantic and UK retail sales dropped 0.5%. Meanwhile, Japan's inflation running hotter than expected. Now add all of that to the geopolitical oil shocks. U.S.-Iran tensions in the Strait of Hormuz have pushed Brent crude up more than 5% for a second week, holding right near $97. Traders are definitely on edge here, pricing in both a prolonged supply shock and the slim hope of a diplomatic off-ramp. So, what does this all mean? Well, that unease is showing up loud and clear in asset flows, creating a really stark divergence. Equities are taking a hit. The S&P 500 finished the week down 1.4%. Why? Because the bond market is incredibly nervous right now. The 10-year U.S. Treasury yield surged to test a fresh 20-month high at 4.74%. And, as you know, when bonds get jittery, capital aggressively flees to alternative stores of value. Gold surged 5.5% to hit $4,680.60. And Bitcoin? It jumped a massive 22%. All right, shifting gears, let's move straight to the trading floor with our global FX technical setups. Now, before we look at the dollar index levels, we have to highlight this absolutely crucial soft point out of Washington. Fed Chair Kevin Warsh explicitly defended the Fed's operational independence against fiscal policy interventions. This strong line-in-the-sand stance on anchoring inflation is the fundamental driver behind U.S. dollar action today. And this brilliantly illustrates why the DXY remains a tactical sell-on rise. The index has found support at the weekly pivot of 98.48 so far. But, mark this down, if that 98.48 level breaks, we are in for a serious U.S. dollar sell-off. You've got immediate support just before that at 98.60, and overhead resistance is currently capped at 9900. Over in Europe, we're seeing German 10-year bond yields ease slightly from their multi-year highs, settling at 3.25%. But ECB President Christine Lagarde just delivered a really urgent call for reform, basically noting that the pillars of past growth have weakened. This sobering fundamental backdrop is exactly what's framing the euro right now. Translating that fundamental backdrop to the Euro-USD setup, the pair has actually benefited from all that pressure on U.S. bonds we talked about, leaving it quite overbought. Because of this, you've got to be patient. The tactical view here is strictly buy only on dips. You want to rely heavily on that key weekly pivot at 1.1738. If it dips, look for support at 1.1656 and 1.1612. Moving to the UK, the 10-year gilt yield advanced to 5.06%. Remember those weak UK retail sales we mentioned a minute ago? Well, combine that with a larger-than-expected monthly fiscal deficit, and it's severely complicating the new government's budget. Because of this fragility, swaps are now pricing an 84% probability that the Bank of England will just hold rates steady at their next meeting. For GBP/USD, or cable, this translates to a buy-on-dips strategy. The pair is slightly overbought right now. So if you are holding long positions, your prime profit-taking zones are the immediate resistance levels at 1.3672 and just above that, 1.3729. So the crucial point is how this shifts as we look at Japan. Their inflation dynamics are running really hot, which is intensely dialing up the pressure for a broader, sustained policy response. The 10-year Japanese government bond yield is holding near 3-decade highs at 2.88%. Markets are now pricing in a 54% probability of a 15 basis point rate hike by the Bank of Japan in September. They're effectively being forced into a corner here. Looking at the USD JPY technical parameters, things are incredibly tight. It's a buy only on dips environment for sure. The absolute key for any long position is the pivotal 157.50 level. You've got immediate support at 158.62, while you'll face heavy resistance first at 159.77, and then all the way up at 160.55. All right, let's pivot over to the Asian subcontinent for our Indian market's tactical views. India is showing some remarkable resilience right now amidst all this global bond market chaos. In fact, we are seeing a fascinating internal divergence in Indian equities. Look at this. The large-cap Nifty 50 took a slight hit, closing down 0.47% for the week. But the Nifty small-cap 100, it jumped 1.2%, hitting a fresh 52-week high. You have to notice how these smaller stocks are completely ignoring the drag pulling down the heavyweights. Drilling down into the local soft points, the rupee slipped to 95.69, pressured by those elevated oil prices and persistent PSU bank selling, even despite the RBI stepping in to fight back. The 10-year GSEC yield is hovering around 6.87% on fresh government borrowing. And that stock divergence we just talked about, it's all about sector rotation. It clearly favors hard assets right now. Power, metals, and real estate are winning, while IT, autos, and FMCG are under quite a bit of pressure. Now, for the USD-INR pair, you have some conflicting timeframes to navigate here. On a daily basis, it is a sell-on rise, but zoom out to the weekly timeframe, and it actually becomes a buy on dips, with the macro pivot sitting at 94.87. You have support at 95.43, but be very careful with the resistance zone between 95.82 and 95.91. If that resistance breaks, it opens up some major upside. And finally, our tactical verdict on the Nifty 50. Look, despite snapping a brutal 7-day losing streak with Thursday's recovery, those marginal Friday gains just weren't enough to save the week. Structurally, this is a clear sell-on rise. Your immediate resistance is at 24,344, followed closely by 24,561. Downside support sits at 23,900. So as we wrap up this technical overview and head into an incredibly data-packed week featuring PCE inflation, GDP, and of course, Jackson Hole, I want to leave you with this final provocative thought. We are also getting earnings from NVIDIA. The ultimate tech reality check is literally right here. With global growth wobbling and safe havens surging, does the massive AI boom still have the economic fundamentals under the hood to keep pushing higher? Or is a major repricing imminent? Keep your eyes on those levels, stay sharp out there, and we'll catch you on the next explainer.